All right, hello everyone. Welcome. For those who are new, I am Continuous Compounding. Yeah, today we're going through a company called Zett 8135. If you are new here, essentially, last 2 days I've been doing a single stock live stream. So I'm just gonna introduce that concept to you guys. So before, when I did live streams, I would basically do a pre-screening, and then through the screener I would pick some stocks, and then I'd go through the hassle of like finding filings, translating them, and then by the time I actually start the actual stock analysis process would take anywhere between like 30 minutes to even like an hour. And so what I decided to do is I'll have different live streams. I'll have a live stream that is a pre-screening live stream, and then I also have a stock analysis live stream. So after I've identified stocks that I like, I've accumulated the filings for them. Then I will do for each stock that looks interesting to me, then I will do an actual live stream on it. So the last couple of days, I have last 2 days, I've gone through two companies. One is Morinaga, and then another one is Ichikin. So Ichikin was yesterday, and if you clicked into any of my stocks, for example, let's look into my stocks. The top comment by myself is typically the one that shows you at what time the recap starts. So all you have to do is just click on that time, and it will go right directly to the recap, where I recap exactly what I saw, my analysis, and my viewpoint on the stock. Of course, nothing is investment advice. Everything is just nothing is investment advice. Do your own due diligence, and seek assistance from a financial advisor, pretty much. And do your own due diligence. Yeah. So without further ado, today we are looking at 8135 Zett Corporation. Oh, we have a comment from somebody. So sometime crush. Woo. Went to the Berkshire meeting this year after watching your vlog. Really? That would be no way. You're just saying that, aren't you? There's no chance that there's no chance that you actually went to it because of me. I mean, if I did, I'll be very glad. How did you like the annual meeting this year? Sometime crush. Yeah, I haven't even gone to I haven't even had the time to watch the Berkshire annual meeting this year with Greg Abel and then Warren Buffett in the audience. I didn't actually get to watch that. So yeah, I'm curious, how did you find it? Okay, so let's start the analysis on Zett Corporation. So Zett Corporation engages in the manufacture and wholesale of sports equipment in Japan. They offer baseball bats, basketball wear, gloves, and other apparel products. It also operates ZNet, an online ordering system to search and place orders from approximately 3,000 stores. So yeah, so essentially this company is I want to say mainly a wholesaler of sports equipment, and they have the thing about them is that they have very low margins. Okay, so literally 1 to 2% margins on their products, and the thing about them is that their revenue is very consistent, and it gradually increases, just gradually increases. And because of the low return and the amount of cash that they have on the balance sheet, they have 10 billion yen of cash, 4 billion yen of investment securities, and not a lot of debt. It actually trades at a negative enterprise value, and if we include investments, it trades at an even further negative enterprise value. So this just tells me the market is just saying that they're not really good at allocating cash or growing the business, and it has pretty poor business economics if you think about the 1 to 2%. But that's probably due to the markup that they have on the sporting goods due to being a wholesaler. I'd imagine that manufacturing has slightly better margins, but it depends on what type of product categories you're creating it for, what your target customer is, and I'm curious if they have any like sales to like schools, for example, for their gym sports equipment, right? It trades at a 0.56 times price to book. So if it were to get to 1 times book, there'd be a 78% upside. PE is 9.5 times. You're getting an 18 yen div yield. So that would be a 4.2% yield. Let me take a look at the most recent share price for the stock, 406. Oh, 406, so pretty similar. 406, so it's dropped a little bit, so you probably get an even increased dividend yield, so 4.4% div yield now. Yeah, and if we look at the last couple of years, we can see that revenue has increased, in the low single digits, and EBIT margin has stayed, around the 1 to 2% range. Yes. So what is my goal in looking at this company is to see if this are so cheap, is there potential for them to, how are they raising dividends? Are they going to be performing buybacks? How are they going to be allocating those excess cash? Is there something about the company that the investment public is missing in their 1 to 2% margin? And just looking for areas in which there could be potential mispricing and room for revenue growth and margin expansion. That is essentially what we are going to be looking for today. So I already have the documents in place. All right, so Time Crush is Sometime Crush says, it's true, my coworker met Greg Abel, and we drove through many wind turbines in Iowa on the way there. Oh, cool. I found it good, except no annual movie this year at the beginning. Warren spoke a little, tiny bit. I see. Okay. Yeah, I flew in to Omaha, Nebraska. So I'm from Canada. I contemplated driving all the way there, but it's a very long drive. And literally because Omaha is in the middle of nowhere, the only way I could justify doing such a trip is if I were to drop into certain towns, small towns, and rent a hotel or Airbnb and play some poker, essentially to get there. But yeah, I didn't think that I would be staying there for that long. The first time I went, I did go for, I believe it was a week or 7 to 10 days, if I remember correctly. No, it was a laid back atmosphere. It was nice to see how, Warren Buffett, what his environment was like, and I found it quite inspirational. And then, I see that his environment allows him to concentrate. There's not a lot of distractions, so if you really want to bunker down and, focus on investing, you definitely can, right? There's not a lot of external stimulation there. So, how was your coworker able to meet Greg Abel though? That's very interesting. Um, like, was this at some after party, or is that like through some type of business connection that you guys are able to do that? Oh yeah, annual meeting would be interesting, but I feel like the annual meeting typically pays tribute to some individual. So, and yeah, I remember that sometimes they'll have skits. So I guess unfortunately this year they didn't have a skit. What would be cool is if they had a annual movie that kind of like showcases the semi-retirement of Buffett stepping down as chairman. I think that would be good. But maybe they're holding on to that material until a later date for the inevitable, maybe at some point. Yeah. Oh, that's really cool. That's really cool. Yeah, I think that's nice because I think that Buffett is just too popular. So I think if he walks around nowadays, like just randomly, he would just be surrounded by people. I think Greg is, not at the stardom of or popularity of Buffett. So I guess if you were to walk around, not everyone's gonna want a picture or something. But I would expect him to still be quite popular and still. But I think it's also important to build good relations with shareholders. and people still attending the meeting because I mean, let's be real, a lot of people aren't incentivized to go to the Berkshire meeting now that Buffett is no longer and Munger are no longer chairman. But I would say that the meeting is still a good place to meet like-minded investors. So I guess you get that networking, you get that, get to surround yourself with like-minded individuals, which, to be fair, it's like, it's hard to meet value investors or people who are really interested in investing outside of work or even in certain cities. So yeah. Oh, yeah, I'm from Canada too. Yeah, yeah. Greg, hire me in the future. So yeah, continuing on with the so basically what we're looking for is there an angle at which we can see them either increase profitability, increase revenues? Because if you look at the margins, yes, our margins are very, very low, right? So in what ways can they allocate capital? In what ways can they grow the business? Yeah, so that's what we're looking for this company so far. And I was also interested in understanding what the business truly does. So revenues increased 6%. Operating profit increased 17%, so a little bit of operating leverage, which is good. The income dropped a lot though. Potentially there's some type of write-down. Some type of investment loss maybe. Dividend has not increased, has stayed the same. It's forecasted to stay the same, which is unfortunate because they have so much cash. So this is a red flag for me. Did not raise dividends, kept it the same at 18 yen. So they're forecasting 42 yen EPS. So if they give out 18, that's 21. So a little under 50%. So around like, little over 40% DOE. I guess they just have a consistent DOE. 59,980. Is this consistent with what I wrote here? No. Oh, this is the new one. This is the new one. So I should factor this new one in. No longer forecast. The real one is. So revenue is expected to increase. That's interesting. 980. So that's supposed to drop. Operating profit is 1,200, right? So this is ordinary profit. Sorry, ordinary profit is expected to increase though. So I would ask why. Ordinary profit expected to increase. And appreciate you joining me today, Sometime Crush. Yesterday there was a little bit of an audio issue where the mic went tick 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 tick. If at any point you hear a tick 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 tick, please let me know. That's something I wanted to address. It's something to do with the audio filter. So if you hear something like that, that'd be great. Appreciate it. Okay. Yeah, not much. No share buybacks, or very little. Last year 58655. 58655. Oh, so it increased higher than their projections. 1251. That's pretty good. 1251. So they're being more conservative given the most recent results. So this is good for this. Looks good. So is there any recent development that led to the outperformance? Any recent development that led to the recent outperformance in fiscal year Okay. Oh, I guess since this is a new, because in May a lot of companies issue their financial statements, so there's a new set of financial statements. So I will just be essentially filling this in. Might as well, so we get the most up-to-date numbers. And then we'll look at the commentary. 9099 plus bills receivable. 9099. 389, okay, 393 dropped a little bit. Long-term loan schedules for repayment 101. Long-term borrowings. Cool. All right. Book value went up a little bit. 331, 52. And then based off of forecasted net income, 830, slightly lower, 9.6. Cool. So these are the latest figures. Total negative enterprise value 0.5 times book, 4.4% div yield. FYI, they're doing window cleaning today for the apartment I'm at, so you might hear some like noises, but it should be fine. Okay, let's look at the management commentary on business so far. Consumer purchasing power is decline is what they're saying. So they cite declining birth rates, seasonal changes due to climate change. So if people are the weather is worse, then people aren't outside playing baseball as much. Rising logistics costs, I think, is the main concern due to an increase in oil prices, labor costs. But they say tailwind is health consciousness, continued interest in sports and diversifying lifestyle, stable purchasing power is being maintained across a wider range of fields, including running and outdoor activities. Yes, a lot of health conscious people do run. In addition, demand for sports brands for everyday use is expanding. Against this backdrop, the sports goods market is expecting to grow in the medium to long term. Okay, so for the medium management plan, they want to strengthen the unity of their company, achieve greater heights, increasing trust and confidence in their brand, creating system culture that enables them to generate consistent generating profits long term. They want to grow and expand sales, improve management efficiency. I wouldn't be surprised that this company has a lot of management inefficiencies or business inefficiencies, given their really low margins. Proper inventory flow management, investing in equipment to reduce manpower. That's good. We have wholesale division and manufacturing division, so I'm interested in looking at exactly what the split is between these divisions. I expect wholesale division to be their largest because their margins are so low. It has to be this. Zett Baseball, a brand specializing in baseball and softball equipment, saw steady performance in gloves, bats, and apparel. Tennis badminton equipment saw increased demand for domestic competitions and for high-priced items such as high-end rackets, avionics. Soccer equipment continued to perform well, particularly apparel and footwear, while other items such as track and field spikes, running shoes, and table tennis equipment performed strongly, partly due to inbound tourism. Okay, in the lifestyle market, high-performance shoes continue to perform well, and apparel-related outdoor equipment also performed steadily. Manufacturing division. At Zett Baseball, a manufacturer of baseball and softball equipment, the new standard hardball metal bats and white spikes continue to receive high praise, and custom-made gloves perform well thanks to the success of professional staff or professional sponsored athletes. At Converse, a manufacturer of baseball equipment, referee wear and other items continue to perform well. On the other hand, the business environment for the manufacturing division is challenging due to soaring raw material costs and the continued depreciation of the yen against the US dollar, resulting in persistently high manufacturing costs. 9% increase compared to other periods, 6.3% increase. Okay, retail division. We worked to improve our specialized product range and customer service quality, but we had to consolidate some stores, and the mild winter at the beginning of the autumn-winter season caused a slight stagnation in sales of high-priced items. Weird that they decided to do a retail storefront. Logistics division. Sales decreased slightly due to decline in the volume of sales work. As a result, net sales were down. $744 million. Logistics division. Sales were 330 million yen. 474, 744, and then their sales for wholesale is 57 billion. Yeah, so this is majority. I mean, this adds up to like, what is this? This is 1.5. So this is like 1,500 million. So this is 1.5 billion. This is 57 billion. So it's not even close. Manufacturing is not even close. So like, yeah, they're just not doing that well. Definitely just a logistics company. So this is a volume-based business, which is why margins are so small, as I predicted. I think it's just the nature of the wholesale, that they just get like 2% margins on things, because they're just literally just redirecting it, taking in inventory and then redirecting it. So margins are, yeah, they're handling the logistics. So what I would like to see is like, where are their factories, and then is there increased capacity going down the road where they can have more, where they can handle more inventory. Doesn't seem like there's a lot of investment in like new facilities. So So curious what the margins are for the other three segments that they have outside of wholesale. Gross profit, advertising, freight charges, rent, executive compensation. Why the fuck is executive compensation so damn high? Interesting. Executive compensation is around 5%. Is that reasonable? Is that reasonable? Hmm. 3.3 billion. 33 million. 33 million on a company with a market cap of 8. Wow. Company has a market cap of 8 million and you're paying yourself 3.3. That's a red flag, I think. Is it executive comp too high at 3.3 billion and M cap is 7 billion? What the frick? Non-operating income, interest received, dividends received, rental income. No revenue breakdown. Okay. Next one, let's see here. I'm just curious what the margins are for the other segments. Probably have to look into share ownership. So, okay, so operating profit increased due to gross profit increase, so increased margins. But then there's increase in the logistics costs, increase in labor costs, increase in overall expenses. Oh, they have a lot of categories. Nice. Liking that. So, baseball is the biggest one. Then tennis and badminton. Second. 6 million soccer and futsal. Table tennis. School physical education competition equipment. Yes, so they all definitely sell the school. 2.5 million. Basketball. Football. Swimming and other sports. Lifestyle centers. Outdoor footwear, apparel, and other lifestyle. Interesting. Wellness and body care. 5.6% increase. Footwear increased the most, 23%. Geared composition ratio. Baseball at 18%. They also own their own private label for baseball. That's interesting. Table tennis also increased substantially. Footwear increased a lot. Outdoor dropped a little bit. Apparel. So, their lifestyle category is doing quite well. Lifestyle is doing well. Interesting. Okay, so in 2025 they increased dividends substantially. That's it. That is it. I would have liked a breakdown in the way that they said that they have, for example, over here they have wholesale manufacturing and retail division. See if their SR has it. Gintoku, Zett Kyokai, Watanabe Yasuo, Watanabe Hiroyuki Watanabe. Hiroyuki owns 2.5%. Or 2.5%. 492,000 shares. Is that Employee Shareholders Association? Watanabe Sports? Molten Corporation. Shintoku Company. Zett Kyokai, Representative Kiyoshi Minami, President and CEO of Molten Corporation, is composed of our business partners. This is an unincorporated organization whose purpose is to purchase shares of our company using contributions from members, or to strengthen ties between the company and its members and to contribute to the wealth building of its members. Okay. 29146. So the company is owned by the Watanabe company, family. Well, it was founded by the Watanabe family, which is why there's the Watanabe's here. Yasuo Watanabe. Tanabe Sports. It's a major retailer in Osaka. Molten Corporation is a premier global sports equipment manufacturer best known for world-class basketballs, volleyballs, and inflatable ball type. Given that Zett acts as a dominant domestic wholesaler and manufacturer of team sports gear, Molten's direct stake reinforces a critical manufacturing and distribution alliance. Action is further emphasized by Molten CEOs leading the Zett Kyokai Partner Alliance. Okay. Molten Corporation. Are they publicly traded? Molten Corporation is a private company. Okay. But they supply balls, essentially. lifestyle footwear. What about running? Where does running land? Outdoor could be just, these could be hiking shoes. I don't know. This one could just be Stan Smiths or Adidas Stan Smiths or Air Forces, right? They don't give a lot of data. Let's see if they have a good breakdown here. 55309. This is the revenue breakdown, but they don't do breakdown here. They don't give enough information. How many employees do they have? Employees 588. Then part-time is 214. This is more of a supply chain logistics company. They're a sporting goods company, mainly logistics. So inflation goes up on sporting gear equipment. This is good for the company. Oh, brands that they hold exclusive distribution rights. Converse, that's important. Team Z, J-Fit, Canadian East, and Tool. This is also roof racks, I believe, on cars. Multifactional neckwear and headwear. American made dance, exercise, and studio shoes, and Rika. I know this is a thing. We are Rika, made for women. Resort Max Classic, Devotion Max M2. These are dance exercise shoes. Interesting. I didn't know that was a thing. I didn't know that people did that. So I can see them used for like, I don't know, cardio dance classes, I think. Yeah. Nice. Technical training products for competitive swimming from California. I think exclusive distribution rights is very important because that definitely yields to higher margins. Zett baseball. How How big is their thing? 66.7 thousand. Well, they definitely have some professionals. These are probably like minor, like Japan League professionals. Zett. Zett Samurai. Zett by Beams Design. Beams is a pretty well known brand. It's interesting. Koyfin Fitness. That looks pretty new. Tool, I know is a big company. This I don't know about. Headwear and neckwear. Headwear and neckwear. Oh, probably to protect against the sun. Or potentially even like mosquitoes or flies when you're outdoors. So you don't have to wear sunscreen. Yeah, probably snowboarding as well. Interesting. $5,000. I feel like they could definitely acquire a baseball company. They definitely could. Their Zett baseball is actually quite a bit of followers. Not bad, actually. Yeah, pretty good. Zett also plans and produces basketball wear for Converse, which enjoys enduring popularity among young people. Guangzhou Jena Training Company. They work with 800 different companies. Bolton, Yonex, I see Yonex, Puma, tennis rackets, martial arts. Okay. Automating using robots. Also working to diversify logistics services by handling contract logistics and joint delivery, actively promoting the strengthening of distribution capabilities. So that's also another area that I'm interested in, is like the revenues from distribution, just general logistics distribution, which don't really cover here, which is annoying. Quite annoying. gonna take a look at their last year's securities report, even though this year is not out yet. They're using robots. Oh, retail department is lodge, a specialty store for mountain and outdoor activities. Our main business is in store sales to general customers at our directly managed stores. So this is mainly for like hiking. Table tennis comprehensive site. Team.com. Design simulation for teamwork for each sport. So I guess if you're a high school, elementary team, middle school team, and you guys want to make a uniform, you guys can use this, I guess. They have Champion and Adidas here too. Oh. Interesting. Zett original easy order gameware. Zett original easy order training wear. Zett original. So this is designs that only Zett has. But yeah, this is work with Adidas for the logo. Custom order system. I don't know what TZ is. What is TZ? Oh, this is their own in-house brand. Team Z, I guess. Oh, interesting. Okay, so let's recap and look at everything and see where we want to direct our research if we wanted to. So, looks like revenue is going to continue to increase. They're one of the top distributors. So there's definitely some economies of scale to having, you know, higher revs, for sure. Doesn't seem like they're actively allocating cash. That's the issue. They did raise their dividend in 2020. It was a 4. 2024, I believe. Correctly. 2025. Oh, interesting that lifestyle's gone up a lot. Also, working out has also become a bigger trend. So I think there's two tailwinds. There's like working out culture and looking like you're working out culture. Obviously, doing certain activities are higher recurring income than others. But you're not going to be changing your baseball bat all that often because it's unlikely to break. But you're more likely to change your running shoes. That is an example. The media management plan. Let me try to find that. That would be interesting. That'd be interesting. So I think they also need to build more like exclusive brand partnership. More exclusive brand distribution right company. So I guess they're starting small. They're targeting some smaller brands to be the main distributor, which is good. I have no concept of scale here. Like is this impressive or not impressive? Like having this much revenue. Like, is that impressive or not? I don't know. And then have they invested in like expanding their factories? Because it seems like potentially with their current asset base, this is the most that they can kind of deal with. Buildings and structures, 2.5 billion only. And they handle that much sales. I do feel that their executives might be overpaid though. I genuinely think so, because if they were able to, if you were able to cut the executive compensation by a bit, that would be very additive to margins. Hoard cash. I'm going to continue to hoard cash. This is my read on this situation. What, 3 times? 0.5 times. 0.5 times is high on that scale. You know, the low of 0.3 times. Price of tangible book value. And or cash has just consistently gone up. Cash has just consistently gone up. They don't have a place to use it. Business. They had positive enterprise value before. They need to buy some brands. I think if they can buy some brands and then be the exclusive distributor, that would change the business model. They've done no acquisition. I need to look at their media management plan. That's probably one of the more important things to look at right now. But they have some interesting things, but they're just focusing on a volume business, and there doesn't seem to be like I like this, you know, exclusive distribution rights thing, but employees has not increased. Maybe they're very optimized for sports already. I'm gonna close the door. Give me 1 second. Zett creates Xylo. Logistics operations of Zett and Zett create corporation. Lodge company, outdoor specialty store. How many stores do they have here? I would imagine they do this because there's higher margins for these type of things. So having their own store and like seeing that, like, right, so they probably distribute for these companies anyways, so they get it for wholesale price. It makes sense, right? If you're into like hiking, you probably wouldn't mind going to a hiking specialty store. They have one store in Kyoto. They have a Rakuten store and then a Yahoo store. Okay. They need more stores then. They need more stores. 1,300 followers. Social media needs a little boost, I feel. There's a lot of growth potential here. That's the thing. Sales and quality control of our own branded products in China. So they make their own offset brands. Logistics operations for sporting goods. E-Lodge. They have one store. Are they mainly just... This would help them increase their margins if the retail store concept works. So I'll give them that part, but it's very in the beginning stages. Oh yeah, medium management plan. I want to look at that. That's important. Authentic baseball equipment. First ever catalog production. Yeah, this look from 2021 till now. What do they have? 2020 was the 100th anniversary. Interesting. Oh, they acquired a wholesale business through M&A, so that's good. Can they buy more wholesale businesses? Can they do wholesale M&A? It seems like they did, right? Like, say the word M&A here. Oh, we acquired the wholesale business of Sierra Sports through M&A. Okay, so they have been able to do something. But it's only recent. So 2021 and 2018. We have 2 wholesale M&A. I would imagine that they're kind of small. 21. Merged with Neo Manufacturing became Zett Create. Taikei Food Factory. Lodge in 1999. Supplier contract with Chinese Baseball Association to supply all baseball equipment used by Chinese national baseball team. Oh, they were trying to expand it into Chinese market. Tokyo Yakult Swallows. For like and up to exclusive distribution, but that wasn't on the list anymore, so that's probably ended. So it seems like either the brands are too small, so they don't mind being the exclusive distributor anyways. But they have done 2 recent acquisitions M&A, which is good. I launched my own original footwear brand, JFit. Now they've gone into shoes. Interesting. The point is JFit though. Buff. This is JFit. There is a fitness craze happening in Japan right now. That is true. Their shoes don't look very appealing, if I'm gonna be honest. JFit 5200. Let's take a look at one of these. Are they dancing? This looks so damn awkward. This is a celebrity? No, some random model. Okay, no. What are these shoes? They look so ugly. Sorry. Who decided to make this brand? Who's their creative director for this? Does not look good. The logo also looks like crap too. Literally looks like they just found a Chinese manufacturer, slap on a logo, and then just like, okay, let's do some marketing, let's start this thing off. Dig around. Doesn't, I don't know, what even is their competitive edge here? Like, I don't understand. Don't see the vision. Okay, so I want to look at their medium-term management plan to see where they think they're gonna go. Yeah, we did that already. They said they had a media management plan. I don't see it. Why did I think there's a media man? This is a slogan? Hmm. Okay, I'm taking a look at the fiscal year 2025. But where is it? Hmm. 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 This is mainly product stuff now. Adopted a slogan only. There's no plan. Just a slogan. What the fuck? That only goes back 2 years. That's campaign? Nope. Okay, looks like they actually don't have a meeting management plan. It is just a slogan. Okay, that's fair. Okay, let me think about this business right now. Very low digit revenue growth. Factors exposure, activity level. I mean, the interesting thing that makes it a little bit less ideal is that Japan, they have one of the lowest obesity rates in across the world, because everyone walks like 16,000 to 25,000 steps a day. You know, like hitting 10,000 steps a day is very easy as a Japanese person, given how much people transit and walk. But this is activity levels outside of their daily walking. So when I was doing research on a company called Fast Fitness Japan, I think they went from the percentage of the population that works out. It went from 1% drop to 0.5% during COVID, and then went from 0.5% back to 1%. I don't know where it is right now. But yeah, so increase in working out participation rates, increase in sports participation rates. The thing is, I don't know what their edge is. What is their as a sports wholesaler? You know, like they do specialize in that, but like, you know, what is their edge? Why would a brand let Zett become a exclusive distributor? Another question there. Yeah, executive compensation too high. Share ownership, there's 120% tranche. Lifestyle segment is doing well. More exclusive distribution rights. Good for company. The Shintoku could be an asset holding vehicle. More M&A acquisition, wholesale M&A acquisition. It doesn't even have to be sports. I think it could be like some type of e-commerce pivot. That could work too. There was one company that I looked at many years ago, a few years ago. Kanto Corp. Let's see. Kanto Corp stock. What is 047? What is the stock price like? What is Kanto Corp looking like right now? Has been a while. Oh shit, it is ripped. It recently ripped hard. Did nothing for a few years. Low of 500 is 5x. Yeah, at some point you could have bought each share for 500. That's 5x. Take a look. Kanto Corp is an example of like an optimized, what looks like an optimized type of logistics operations. But I don't know why it's ripped that much though. Why is that the case? Oh no, Kanto Corp is way larger. Interesting. So, you know, a company like Kanto Corp would just acquire this company, right? Like the business is very cheap. So 31 times EBIT now. It used to be 6 times EBIT. Now it's. Right, this is Kanto Corp. 153 billion market cap. Yeah, it just ripped so much from what I used to know about the company, but yeah, I'm not sure why its recent developments have allowed it to get to this stage. Not really sure what's going on here. Oh, profitability, not good. What's LTM? So I have no clue why the company is trading it. Doesn't make much sense. These are growth multiples. Why is it trading so down? Doesn't make much sense. Okay, but like a company like this could buy out Zett then. But then the question is like, okay, would they be willing to sell? So Watanabe another 5% here. Zett is 10%. Maybe some company, family holding companies, 30%. Someone likes 30% of the company. Might be hard to sell. They need to do more M&A. Okay, so here's the verdict. So a company makes very low margins because they are a wholesaler, which makes sense. And 90 something percent, basically 98, 99% a wholesaler, right? So they're just consistently generating cash, let's call it. Very consistently, very consistent business. You're literally just marking up wholesale products, so it's not much risk in being a wholesale distributor. Price of book 0.5 times. The issue is like, how do they unlock that cash? Which doesn't seem like they're in any hurry or any rush to do something like that. They have areas where they can allocate it, but there's not a lot of conviction, so you can probably just have to pay attention to that. Where can it allocate it? So they can allocate it to the Lodge, which is their direct-to-consumer store where they're selling outdoor equipment. Oh, we got a subscriber. I'm gonna look into that. Usually when that happens means someone has subscribed. So thank you, Cam Morrison, for subscribing. Appreciate it. Always helpful to gain a subscriber. Yeah, so going back, so they can allocate capital into the Lodge, some direct-to-consumer stores. They could also open up some baseball stores. Like, you know, one of the things that they create are baseball sport team wise, baseball gloves, that kind of thing. But maybe they can be more involved in that type of distribution. So sports gear stores, baseball stores, like niche sports stores. But now they have an outdoor hiking store. They have one. Don't know how that one's doing. But if that could work out, they can allocate capital towards that. Wholesale M&A, so acquire other M&A companies that perform the wholesale function in terms of, well, it's better if it's sports, but I don't think it has to be sports, but I guess our focus is on sports. I think that there'd be immediate it's called circle of competence. If even it doesn't, I don't think it has to be sports good wholesale, right? It could be, you do wholesale for e-commerce, wholesale for any maybe adjacent category. But just even in buying a wholesaler, it is within their ballpark. Their areas of expertise, I would call it. Additional work that has to be done on this name is, I don't know what their edge is as a sports wholesaler, because I'm sure there's other wholesalers and distributors that deal with sports equipment, right? So they can't be the only one, in my opinion. Yeah, and then what is the callus of why a brand like Tool? I don't actually know how to pronounce it. Thule, I think it's Tool or Thule, something like that. Why they would have Zett as their exclusive distributor, but mainly because they deal with outdoor gear and that kind of stuff. So maybe they want to do it that way. and maybe they paid the company or give them some type of perk so that they are the exclusive distributor. So I would like to see them do more exclusive distribution contracts with more companies, because that would stabilize the revenues and yeah, also allow them to increase their margins when they sell it too. Yeah, another thing I was wondering was executive compensation too high, because um, it's 3.3 billion, and then the company only operating margin is only like 1 billion, right? So if there's an executive compensation cut, right, then that would be very accretive to their bottom line. So are they basically controlling the company and just like milking it and not allowing shareholders to do very well? That's what it seems like. This could very much be a value trap. What other things? Dividend. They raised dividends in 2025. It's been the same for the last 3 years, but it is a roughly 40 to 50% dividend. Uh, Dividends as a percentage of net income. Yeah, so I can see why it's cheap. It's cheap for a reason. It's low margin. Not a lot of revenue growth, but they are doing things that can allow for revenue growth potentially. But I don't think it's in that stage yet. They have a lot of cash. Let's revisit the actual share price of this business real quick. Have a look at it. Have a look at it. Okay, so it's gone up to a high of around 600, just close to 600. So it's gone down almost 50% from that point. Curious what type of news has resulted in that, but it's consistently just gone up. 200, COVID made it drop to 140, went up 4x in around 6 years. 2025, what's the 1-year range? Give me 3 years, give me July 2020. April 2025 dropped to 367. It's only 10% higher than its other one. 367 went up to 500. Roughly 40%, 40 to 50. Drop back down. I think if you can get in at like 0.3 times price of book, it's a good place to be in. Yeah, 0.3 would be the best, of course, but it doesn't really trade there. What would that look like? 3. Well, let me just take a look at that real quick. So June low is 342. 5% div yield. 0.44 times price of book. Yeah, so I could see that it not drop more than 15%. It'll be hard for it to drop 50%, and that because this company is so cheap. Yeah, I don't see it dropping that much. So the downside is pretty protected, but it also doesn't go up that much. How do you want to play this? Good div yield. You get a good div yield. Cheap. Not great margins. You need to grow the distribution, right? You need to acquire something. You definitely can acquire a wholesaler. I would say still low downside though. Still low downside. Management is milking the company. Feels like there is a expectation. So not much urgency, but once they showcase more urgency, let me just quickly take a look at. Let me take a look at their cash flow statement real quick. Look at if they've acquired any shares or not. And roll, please. None. None. Okay. This is the most amount of dividends ever paid. Okay. Okay. Let's see. Trying to think. I think for the dividend yield, it's not bad. It's not bad. Like, this is okay to have as a starter position, but I think this is more of what I've noticed for a lot of companies, because if they're followed, if there's a narrative shift, if you can act on that fast, then this is more of a narrative shift investment. Meaning, once something showcases some avenue where there's growth potential, where revenue can expand, then this leads to multiple expansion and leads to a re-rating of closer to price book of 1. The question is there a reason for price to book to be more than 1? And I say loosely no. So if there is like, oh, we're gonna open more lodge stores, great. Oh, we're gonna be on a spree of acquiring more wholesale companies, great. If something like that happens, this would re-rate to 1, right? So then the question is, do we want to wait on the sidelines and receive 4.4% div yield and wait for that to happen? I think with the current dividend, that makes it reasonable. And currently the stock is still in an, I would say it's kind of flattened out, but it could re-rate. It can go back up there. Or does it just drop? And the thing is, the company is cheap, so it could definitely get bought out by a larger wholesaler. So yeah, there's some type of leverage buyout or something. Like, this could be easily acquired. That's another thing. Like, an acquisition bid would just be quite nice for this company. Let me think. Like if you think about it from the perspective of any company, right? Like a Nike, a North Face, a big brand. Like, what is this market cap, right? Like, if you can save 2% margin on your products, you can just easily just buy this company out and just be like, well, now I save 2% on all my products, and I own a logistics company, and I get to be more selective on how I pitch my products to my customers. So yeah, be interesting. I think it's a good company. I think it's good. Is it like super amazing? I think if it was 0.3, 0.4 times price of book, this would be, you would have lower downside. Because it's re-rated back up to like 0.5, there is a downside. Like, sure, you can say theoretically, fundamentally, there's not much downside, right? Because revenue is likely going to continue to increase because there's participation rate tailwind in terms of sports and working out. So likely revenues are going to increase. But if we think about like where this thing is traded at, which is like 0.3, 0.4 times price to book, buying this at around 0.4 times is the better play, in my opinion. But is it worthy of like just as a basket approach? Oh, this is definitely something you can throw into a basket and just forget it, like a dividend basket for sure. You can do that. Yeah, given the industry it serves, being sports, being I would think to be more positive. Okay, yeah, okay. So as a recap, because I was very scattered-minded when I was coming up with what I think about the company. This is a low-margin business because they're a wholesaler of sports goods. 98% of their products are sports equipment. Their biggest sports categories are baseball. Second to that is tennis and badminton. And then recently they've had some improvements in their lifestyle brands in terms of footwear. I'm not actually sure how that's the case. The issue with this company is that they have a lot of cash and a lot of investment securities. So technically, even though market cap is around 8 billion, if we factor in net cash, and also investments, you get a negative enterprise value, which makes it cheap. But with any value trap, the question is, how do you allocate cash, which we'll get into in a bit. Price to book is only 0.5 times, so if the company was able to find some route to increase revenue or improve the business or allocate cash, this would re-rate to 1 times price to book. So that's like almost 100% upside. But while we wait for something like that to happen, the company is being generous, decently generous with their dividend yield, which is 4.4%. Price to book is 9.6 times. As we can see, revenue has been gradually increasing. I think it's more in line with just like inflation and that kind of stuff, and probably some increases in business activity. Even margins are in the 2% range, which is consistent with being a 98%, of the revenues are made up of wholesale, which makes sense because you're just distributing the product and taking a little bit of inventory risk. Volume is the key to the business in this sense. Management has increased dividends in 2025, but it has remained the same for the last 3 years. Share ownership, the company looked like if they own the Shintoku company, if that is theirs, that's 19.73%. And then Watanabe Yasuo, Watanabe Hiroki. Watanabe used to be the family that owned or founded this business. So that owns 5.6%. And then Zett Kyokai is also, let's see, is composed of our business partners. This is an unincorporated organization whose purpose is to purchase shares of our company and using contributions from members in order to strengthen it between company and the members. So yeah, that's probably, if they don't like the acquire of the company, they would just utilize Zett Kyokai to block it. So that's a total of 11%. And then if Shintoku is also theirs, then that would be 30% of the shares outstanding, which I don't know about. And then, yeah, so they also have some private businesses that own shares in the company, like Molten Corporation and Tanabe Sports. The things that are exciting, that could potentially be exciting, one is exclusive distribution rights. So having more exclusive distribution rights, because if you're the exclusive distributor, you can charge a higher price premium for the products because you are the only one that a company can source it. So, for example, a Thule that does like camping gear, outdoor gear, that kind of stuff. And I don't know what the brand recognition of Thule is, but I know Thule from roof racks for cars. But let's assume that they're one of the top brands for outdoor equipment and camping and that kind of thing. Outdoor gear retailers who want that product, they can charge more. The next is Lodge. So they started their own outdoor hiking direct-to-consumer store, selling outdoor hiking boots, that kind of stuff, outdoor garments. And they have 1 store currently. I'd like to, if this store format works out, I would like to see them open more of these type of stores in areas where people will be working out. And yeah, because you are a wholesaler, you get these things for 2% cheaper than even from the source. So it's great from that standpoint. And this adds a segment in the business that generates more higher margin, let's call it, at the expense of inventory risk. And then in 2018, 2022, they did wholesale M&A of 2 companies that are in related, that do wholesale for sports equipment, I think. So they have done M&A. I don't know what the size is. I think it's probably very small. So I would like to see them to continue to do wholesale M&A in the sports category or in an adjacent, unrelated industry for goods, but also has where in an area where their expertise can be applied. But I think that it doesn't even have to be sports. It can just be like e-commerce, fashion. It could be anything. As long as it's wholesale, I think that's fine. That would be where their expertise could definitely be applicable. Additional question is, what is their edge as a sports wholesaler? Potentially, like if they have a catalog, then it's easier for schools or retailers just to order from one place rather than with multiple wholesalers. But I think if you're a business owner, you don't really quite mind about that. So I'm curious what their actual edge is, because this feels new to me. Yeah, and why would a brand let Zett become an exclusive distributor, right? Why would they leave some money off the table for someone to be an exclusive distributor when they can sell to everyone? and just push it up a little bit. But it's also easier for certain companies. So like, oh, like for Japan, I don't want to deal with 10 wholesalers. I'm just going to deal with one, and then I just let them do their thing, and that's about it. And then, you know, depends on the scale of the company, I guess. Which is why like I saw some small brands, some dance shoe brands, Reika, saw some yeah, smaller brands. So that makes sense. I think it makes a lot more sense for smaller brands that are trying to scale. Yeah, where manpower, labor power is kind of like at a cost of resources of hiring extra individuals. So why not just give exclusive distribution rights to one company, so that your entire contact for Japan is just one company? I think that makes things easier. And then why is executive compensation 3.3 billion yen? Because if executive compensation was 0, they would earn 4 billion, right? So, you know, that was so like for every 1 billion that's saved from executive compensation, right? We see a doubling. Well, not a doubling, sorry. We would see operating income go from 1.2 to 2.2 billion, right? So then that would be closer to a 3 to 4% margin just from saving on executive comp. So I don't know if, but then if we take a look at executive comp in relation to the total revenue, then it's around 5%. And it's like, executive comp at 5%, is that reasonable? That's something I don't know about. So overall, I think this is a, you know, B plus A minus stock. It's pretty decent. Definitely not like a doesn't seem like a home run, like everything is obvious. But there are trade-offs to this, right? You're trading off, you know, a decently good dividend yield for the potential for something to happen. We still need something to happen, right? Because or else it just becomes a value trap. Right? They're just gonna keep putting the 3.3 billion into the executives' pockets, and this company exists for executives essentially. What we want to see is for net cash and investment securities to be liquidated and utilized in a meaningful way. So yeah, that is pretty much it. Nice. We got some engagement today, and we got a new subscriber, so I'm really happy about that. I'm going to be doing another pre-screening. So last time I did pre-screening, I found 3 stocks. So I'm gonna do another pre-screening then today or tomorrow, and then identify 3 more stocks, 3 or 4 more stocks, and also do the same thing. So if you haven't already, make sure to subscribe, follow me on my X, on my Substack, and of course on YouTube. So yeah, and also I release stock pitches on my Substack. So look forward to that. I appreciate you guys for tuning in. I will catch you